board, and Bernadette and Rachel have always been supportive of my efforts to come in and share some information with you. And today is no different. I'm really looking forward to the information we're sharing today. And just a quick note, while I've been in this business for over 20 years, about 13 years ago, I was working with another lender in the reverse mortgage space. So over the past 13 years, I've always known about this product and known how valuable it is in the right circumstances and when the right information is provided for those clients that could benefit from it. And it was a major decision for me when I came in, choosing a new lender to join in the middle of last year. Norcom's commitment to this reverse mortgage space was very important to me because just heard it earlier today, Connecticut has a significant senior population. It's one of the reasons why we're kind of hovering in that vaccine at 75 plus, because we've got a lot of older residents in this state. And it seemed interesting with the talk we're having this morning. But getting back again to Norcom's commitment to this reverse mortgage space really was a big reason why I came here. And the gentleman we have joining us for our presentation today, John Luddy, is a tremendous resource for us here at Norcom for our referral partners that run into clients that need it. And certainly I'm looking forward to the information he's going to share with you. And I'm looking forward to talking to those of you afterwards that want to learn a little bit more about it. So with that, again, thank you for joining us this morning, and the stage is yours, John.
All right, thank you very much. Welcome, everyone. And thank you for coming today to learn about a product that people have various opinions on. And so I applaud you for being here. I'm certainly, it is not my intent today to make you a reverse mortgage expert, but what I want to do is try to help you when you see an opportunity, when you see someone that might be able to be helped by a reverse mortgage. And if we were live, and quite frankly, let me assure you, I'm better live than I am on these Zoom meetings. I'm computer illiterate, so I'm struggling with it. And actually, even the presentation that we have in front of you isn't necessarily the one that I was going to use. So I might do a little freelancing, but you'll learn about reverse mortgages. But what I want you to do is just be able to recognize that, hey, this might be someone that could be helped with a reverse mortgage. And then stop right there and hopefully have us talk to the person, call Bob, call myself, have us see whether or not it's a program that might be appropriate. And so when I'm doing live presentations, I typically bring my Picasso, which is behind me, which you can't really see, but it's right there. And it's an original signed Picasso. And it's numbered, signed with the water seal. And I bring it on the road with me to say, you don't need to be an art expert to recognize that as an original signed Picasso. And you don't need to be a reverse mortgage expert to recognize a client that might be able to be helped by a reverse mortgage. So that's what I want to do today. Before we get talking about reverse mortgages, let me just tell you an interesting mortgage product that you might want to introduce to your older clients that are, say, 62 or older. And how about this as an opportunity for an older client that has a significant down payment? Say they have at least 50% down, a mortgage where they can determine what they want the payment to be. And they can do that each month. So they can decide how they want that loan to amortize on a month-to-month basis, so that they can this month pay it on a 30-year amortization, and then maybe change it to a 20 or a 15-year amortization. And so they can go ahead and make that payment. Maybe they want to pay interest only. And the money that they pay in and prepay will go and be a dollar for dollar reduction in their mortgage balance. So if they mail in $1,000, their mortgage goes down by $1,000. And this product that I just want to introduce to you briefly is even better than that. That money that they prepay goes directly into a line of credit. And the borrower can call the bank and say, send me back that money. So when you're prepaying this mortgage that we're going to talk about, the money will go into a line of credit and it can be borrowed back. So no one's going to call you on the 1st or the 15th or the 30th saying, where's your mortgage payment? Because you don't have to make a payment. But if you do, and let's say you pay $1,000 a month for 10 months and now your roof starts to leak, you can call the bank and say, send me back my 10 grand, and you can borrow it back. And it gets better than that. The money that you prepay is reducing your principal interest, goes into a line of credit for future use, and it grows. So your line of credit grows at the same interest rate as what your mortgage is accruing. So let's say your rate of interest is 4%, your line of credit grows at 4%. And it gets better than that. It can't be canceled or called like a traditional line of credit. And it continues to grow regardless of the value of your property. Now, who wouldn't want to do that? What 30-year-old wouldn't want to have that flexibility when they're buying a home? Well, what I just described to you in Essex, not in Exeter, Connecticut, in essence, is a reverse mortgage. Reverse mortgages have no prepayment penalty, and we think of them mostly as a refinancing tool, and we think mostly of them as a mortgage that you never have to make a payment on. But remember, because this is a there's no prepayment penalty, you can always pay whenever you want, as much as you want. But unlike any other mortgage, when you do that, that money will go directly into your line of credit. Your line of credit grows, and I'm going to talk to you about that, and you can borrow it back. So what senior over 62 shouldn't consider that when they're buying a home? I mean, I believe if that were available, that would be the only mortgage anyone would want to be able to apply for. A mortgage where they can decide on a month-to-month basis what they want to pay, with the flexibility of paying nothing and borrowing it back again. So that's what a reverse mortgage can do. But let's just talk about the basics of a reverse mortgage. Basically, the reverse mortgage, and it's traditionally been a refinancing tool. So we typically would understand that as someone who has a lot of equity in their home that takes a reverse mortgage, pays off anything they do own on the home, and then might take monthly checks or put money in the line of credit. But you can use a reverse mortgage to purchase a home. And I want to talk to you about that, why a client will want to do that. Obviously, the flexibility that I've talked about is important. But what do those clients look like my Picasso? Let's suppose you have someone like myself. I turned 65 this year, which I'm sure comes as a shock to you because I dye my hair gray. So, but I'm still working. So, and my wife and I live in a, your traditional 8-room colonial, and it's a lot of work. We have a pool and we have 2 acres, and it's a lot of work. So we decide that we want to right side, not downside, but right side. And we want to go and buy a ranch. And we see something that talks about senior living, and they're on the market. And let's say they're on the market for $400,000. And my house is worth $400,000. So I could sell my house, buy that house, and have no monthly mortgage payment. So we go to the open house, and it's 400,000 and up. My wife falls in love with the model unit. We say we want one just like this. Well, remember that and up? Although they're 400,000, Mike, and up, that one's 500,000. So now we've got to come up with an additional $100,000 if we want no monthly mortgage payment. I say, okay, I could do that. But then I can't net 400,000 for my home. By the time I get it sold, I'm only going to net 350. Now I'm $150,000 short. And I just walk away from the deal. So I'm stuck in the house that I don't want to be in. The realtor lost the listing on my house and the sale, and hopefully a sale of my house too. Someone's going to sell it. And the sell of that new unit that I was going to right size to. So the whole thing goes up in smoke because I don't want to have a monthly mortgage payment. Well, if I were introduced to the concept of a reverse mortgage, I could sell my home, net out my 350, put it down on the $500,000 new unit, and do a reverse mortgage for the $150,000 I'm short. And now I could continue to have no monthly mortgage payment. Or I might say, well, I'm still working, so I'm going to continue making payments. And as I said before, I could determine how much I want to make a payment for, and I'll make a payment for the next 5 years while I'm still working. And then at 70, I'll retire and stop making payments. And then I pass at 75. That money that I had been paying in my first 5 years went into the line of credit, and it grew over those 10 years. And now my wife can draw that money out to replace the Social Security that she's going to lose when I do die. So it's a very interesting way to not only buy the home that you want to be in, but also put it as part of your total financial plan. So let me now start at the beginning. For most reverse mortgages, you need to be at least 62 years old. It has to be your primary residence. It can be a single up to a 4-unit, so people can refinance at least into a multi-family, and we do see that. Condos are acceptable if they're FHA approved. If they're not FHA approved, I'm going to talk about another product. Right now, I'm talking to you about the FHA reverse mortgage. And what does that FHA mortgage insurance do for the client? Most times when a lender is talking to you about mortgage insurance, it's to protect the lender if you default. With an FHA reverse mortgage, it also protects the client. And it means that the client can never owe more than the home is worth. So when the day of reckoning comes, and I'll talk to you about what would cause the borrower to need to repay the loan, but when the day of reckoning comes, if they owe more than the house is worth because they hadn't been making payments and their loan balance grew and their value went down and now they're underwater, the federal government will pay the difference to the lender. So that federal mortgage insurance means your client, our borrowers, nor their family, nor their estate ever have to use their own money to pay this mortgage off. unlike a regular traditional mortgage, let's suppose you have a client that goes underwater, you know, they could be sued for the difference if there's a short sale by the lender. So this is a non-recourse mortgage. You can never owe more than the house is worth. When you owe less, that money is yours. Because when you use a reverse mortgage, whether it's to purchase or refinance, you always own the home. It is always yours. You're not selling it to the bank. The bank doesn't end up with it in the end. The bank doesn't want to sell it in the end. You own the home and you own the equity. So easy numbers. If your house is worth 200,000 and you owe the lender 100,000 at the time that it needs to be paid off, you sell the house for 200,000, you pay the lender and you walk away with the 100. If you owe 200,000 and the house is only worth 150, the federal government will pay the difference. Okay, so you never have to kick in your own money, so to speak. Even if you have money, it's a non-recourse mortgage. You bought federal mortgage insurance that protects you and your family, you know, or your client and their family. Now, I do want to mention something that realtors need to know about, because I get a panic call from a realtor probably once a month. And they say, you know, I understand that you know a lot about reverse mortgages. I got a real problem. I'm going to list this property for an estate. And I'm going to use easy numbers so I don't have to use my calculator. There's a $300,000 lien on this house. It was never worth 300,000. The family wants me to list it, and why bother? Okay, when we close on a reverse mortgage, we know that that client does not have to make a monthly mortgage payment. So we don't know how much they're going to owe at the end. So we need to make sure that we put a lien on the property that is large enough to repay the loan. Now, they don't owe that amount. Okay, they only owe what their balance is. But we lien the property 1.5 times the appraised value. Okay, so if the house is worth $200,000, we're going to lien it for 300,000, 1.5 times the 200,000. And that's important to remember, because I do get that panic call at least once a month saying, hey, I understand you know something about reverse mortgages. I got these people, they want me to list their mother's house. It was never worth 300,000. How did she ever get a $300,000 mortgage? She took this out when she was 80. Well, she didn't borrow 300,000 and she doesn't owe 300,000. She only owes what her balance is. So her house was worth 200,000 at the time. She may have only borrowed 100,000 and now it's grown to 120. That's what she needs to pay off. So don't panic when you do a research on someone's property when you go to list the property. They only owe what their balance is. If they've gone underwater, list it anyway. Okay, because typically the lender will let you keep that listing. If you've got it listed and you listed the property by the family. So let's talk about, when does this mortgage come due? It's got to be your primary residence. So when you no longer occupy the property as your primary residence, the loan becomes due. What would cause you not to live in the property as your primary residence? You get your Irish up, move to Florida. You move into assisted living or in with a relative, or you meet your final rewards. So as we say back home in Ireland, when you kick the bucket, the loan becomes due. and the lender gives you 6 months and then 2 3-month extensions to sell the property. So, you know, you will be sometimes confronted with a family who says, my God, my mother died. And 2 days later, we got a letter from the bank saying they're going to foreclose on us. Don't panic. The terms of the mortgage gives them a year to sell the property. So if they put the house on the market and they want them to list it with a realtor for a reasonable price, so they will do an appraisal. The reason why we do that, we want to make sure that if you have adult children living in the home, and they want to be squatters for a year, so the house is worth 300,000, they're not going to let them put it on for $1 million. They want you to put the house on for a reasonable price, and then they give you what I would consider more than a fair amount of time to sell that property. And I would say to you that, you know, we all live in the moment right now. The thoughts of taking a year to sell a property seems crazy, but you know, there's been times in my career, I've been at this 37 years, that it takes time for people sometimes to sell a house. Right now, I don't think we're experiencing that. But if you list it properly, you're going to get it sold. So they will cooperate with you and let you work with them, even if it's underwater. So make sure, don't worry about what's liened on the title, and get the property listed. The loan is going to come due when it's no longer the primary residence. If there's 2 borrowers, both borrowers. So the last one out, turn off the lights. If they are underwater and they want you to help facilitate a deed in lieu of foreclosure, you need to understand that let's suppose that person wants to move to Florida. They just hit the Powerball and they got $300 million in the bank, but their house in Connecticut is underwater. They can walk away from that. They didn't sign for this loan personally. They don't pledge that, like on a forward loan, you're signing your full faith and credit. So you could have a summary judgment rendered against you if you're short. With a reverse mortgage, there's no personal liability. It does not appear on your credit report. So someone hits the Powerball for 300 million, they're underwater in their Connecticut home and they want to move to Florida. They could simply do a deed in lieu of foreclosure. Now, I just want to warn you, as realtors, you might find people that have the family is listing the house, mom died. They want you to list the house and then help them through that. Call us and we'll help you. But the bottom line is, the house has to be broom cleaned, which means everything out of it. And most families do not want to do that. It takes a couple of attempts to do that. And I'll tell you why. Most of grandmother's house have that cape upstairs has an old maple bedroom set that someone might want to put in their beach house, but the family says, you know, no one wants it. Whoever buys mom's house is going to be a young couple. They would probably like it. We'll leave it. Everything has to be out of it, even to the point where custom-made draperies. People say, geez, my mother had G. Fox make those. They cost a fortune when they put them in, and they gotta go. They've got to get everything out of that. I help the family. Now, I say call us to help us. Obviously, we're in the business of writing mortgages, but we'll help you if you have someone that has a reverse mortgage already. I had a couple call me. They had done a deed or they were trying to do a deed in lieu of foreclosure in Arizona. They had moved to Connecticut. And they took everything out of it, but they had a swimming pool. And they left in their little pool house some chemicals for the pool. it's a $50 bucket of chlorine. FHA sent an inspector to the house, said there was still personal items there and wouldn't accept the deed in lieu until they hired someone to go back and get them out. And then they re-inspected it again and then took title. So they really mean it. You got to get everything out of the house. And most people don't want to do that. And people of goodwill don't want to do that. They say, you know, we grew up in this house and there's stuff that some young kids might like, and we'll just leave it here. Gotta go. All right. So those are things that as realtors, when you get involved with reverse mortgages, you need to be aware of and to be thinking about. All right. Now, I know that we're going to do some questions and answers. I don't know if you want to stop me and do some, or do you want me to just plow through? If you have a question, I guess there's a way to type in something.
Yeah, if anybody has any questions, feel free to type it into the chat box. And Bob and I can take a look at that and see if there's anything coming up.
All right. I'll keep raving on. Now, remember, this is most of these loans, and we're going to talk about non-FHA approved loans, but these are FHA approved loans, which means that you have to pass the FHA appraisal standard. Now, most seniors are buying properties that are in pretty good condition. We're not finding like first-time buyers that are using FHA usually have some property issues. But I will tell you, whether it's a forward or reverse, and I've been in the business, as I say, 37 years. Let me just give you some advice. Deliver the bad news as early in the transaction as you can. Get them while their juices are hot. So if it's a young couple and it's a first time buyers and you're showing them a house and you know they're going FHA and you know those windowsills got to be scraped and painted, tell them, hey, by the way, you got to scrape and paint those windowsills. The answer will always be early in the transaction. Don't worry, we'll do it. My brother and I will come over before the closing. Bum, bum, bum. If you wait until the appraisal's done to tell them that, and their mother says, why are you paying so much for those houses? I remember when they built them in 1955, and your sister's got a friend who sells houses in Massachusetts, and she said, you know, rah, rah, rah. And all of a sudden they went out of the deal. So deliver it up front. You would still do the same with a reverse mortgage, although we deal with far less property issues with purchases, because we deal with a host of property issues in the refinancing realm, which most reverse mortgages are, but in the purchase business, we don't. So we've talked about what would cause that loan to become due. The people leave the house, both of them leave the house. Either they pass away, they go to a convalescent home, they move somewhere. The only other thing that would cause this loan to become due is the non-payment of taxes and insurance. So you'll see articles in the paper periodically saying, you know, Molly got foreclosed on because of her reverse mortgage. And it was not her reverse mortgage. It was the fact that she didn't pay her taxes. And a tax lien gets ahead of a mortgage. So we really, really, really want to make sure that people understand that they always own the home. This is not, the bank isn't buying it. There isn't life use. They own the house and they're responsible for taxes and insurance. And that's very important that they understand that. And it's so important that in order to move forward on a reverse mortgage, your client has to do counseling. So there is an element prior to application where your client has to talk with a federal counselor, and they can do that over the phone. And they explain the product to them to make sure they understand the product, and they understand very clearly that they own the house. They're not selling the house to the bank, or the bank isn't. This is not life use. and they have to pay the taxes. And we really, really care about that because a tax lien supersedes a mortgage. And because this is a non-recourse mortgage, remember, the federal government has insured this loan to the bank so that we're saying if you go underwater, the federal government will pay the difference. Well, the federal government is okay with that. It's part of public policy to keep seniors at home. But we don't want to have a tax lien get ahead of us. Bob has his hand up with a question.
I just wanted to say there were a couple questions that came in the chat just now, and I don't know if now is a good time, especially the second one I think is, but the first person had asked, when the person pays back the money into their rate, you were saying that it's a choice they can make for a payment. Can you just discuss what are those interest rates relative to where interest rates are currently? That's their question, is what's the interest rate they're paying? Is it a current market rate?
Okay, so let's talk about reverse mortgages and get into the guts of what someone would expect. There are several different types of reverse mortgages, but basically they're in two broad types. There's the FHA product and there is the portfolio product. Let's talk about FHA. There's basically two types of FHA loans, fixed rate and a variable rate. Most people, most seniors would say, well, I want the fixed rate. The fixed rates are higher than typical market conditions, and right now they're in the 4s. The adjustable rate with the reverse mortgage is the one that allows them to prepay and borrow back and gives them that flexibility of getting monthly checks in the end if they've prepaid. So most people use the reverse mortgage that is the adjustable rate. Now, so they take the T-bill and add a margin to come up with the rate. Okay, so it's going to change monthly based on the T-bill plus the margin. Those are the keys to an adjustable rate mortgage. And some realtors will remember adjustable rate mortgages, but they're not as popular in the forward venue as they are in the reverse venue. So let's just say, for the sake of discussion, that the rate is 5%. That seems a little high, but I just am using this because it hits my mind. And let's say that you have in your line of credit $100,000. Your line of credit, to your question, is going to grow by that 5%. So that at the end of the year, you have $105,000 in your line of credit. You have access to $105,000. Now, I want to make sure that you understand this very clearly. We're not paying you interest. We're extending your ability to borrow the money. So what would cause, it's like a credit card. You take out a credit card and you have a credit limit of $1,000. You pay them on time for a few months and they raise it to $1,500 and then $2,000 and then $3,000. They're not giving you $1,000 worth of money or interest. They're just extending your ability to borrow more. So the money in your line of credit grows and we're simply extending your ability to borrow more. Many people that use a reverse mortgage to refinance a loan or as a refinancing tool might put all of their money in the line of credit and then draw that growth off to pay their taxes. Certainly in Connecticut, we find that many seniors feel somewhat crippled by their local property taxes. We're 169 municipalities squeezed into a postage stamp. So that's 169 town halls and senior centers and and schools and garbage collection and all the things that go along with running a municipality. And municipalities can only rely on property taxes. The government decides who's going to be able to cut up and tax what. It's been traditionally accepted that property taxes will be the dominion of local governments. Although I see a proposal this week where the state now wants to tax houses over 400,000 and call them mansions. So I'm sure the realtors are going to have a lot to say about that. But that having been said, what a client might say to me when they have no mortgage and they're just doing okay month to month, but when their taxes come due twice a year, they're feeling really squeezed. So what I tell them to do is put the money in the line of credit, draw on it if you need it, if the roof starts to leak, but take the growth off and pay your taxes with it. And then it's like having an apple orchard. In the fall, go pick your apples. You haven't cut the tree down, and next year they grow back and you pay, and now the house is paying for itself. It's a renewable resource. Bob, you have more?
I just wanted to clarify, they did clarify in the chat, this is where I wanted to make that correlation for them. So let's say that same person who has some room in their credit line, they've taken out the reverse mortgage and they need some repairs to their roof. The interest rate that would pay at their time moves at the same as what they would be repaying at, correct?
Correct. So the what you owe, your mortgage balance is going to go up, and let's say the rate's 3%. So your balance, if you don't make a payment, you're going to go up, is a 3% interest, and your line of credit is going to go up 3%. So they are the exact same interest rate.
And when money comes from your credit line over to now it's in your balance, those are equal. They're always equal payments at any point during the life of your reverse mortgage.
Equal assessments, yes.
Correct. And the other question that had come in that I think was a perfect one for this is, why doesn't the lender escrow for taxes and insurance to protect their interest?
Well, it's an excellent question. And a lender might do that. A lender might do that. But remember, how are we going to determine how much we're going to lend someone? We're going to take the value of the property and their age. And remember that we're doing this in reverse. So the older you are, the more we're going to lend you. All right. Because in theory, from an underwriting payoff, you're going to pay it off earlier. All right. So it's going to accumulate less interest. Actuarially, the payoff is going to be sooner. So we're going to take the value of the property and your age and the interest rate and determine how much we're going to lend you. Let's just do easy numbers. Let's say you have a $200,000 house. Based on your age, we're going to lend you $100,000. And if you have not paid your taxes on time for the last 2 years, we're going to do a lifetime set aside to pay your taxes for you. But it comes out of that $100,000. So let's suppose someone's taxes are $5,000 and their life expectancy is 10 years. And they have a $200,000 house. And we're going to lend them $100,000. We're going to hold back that $5,000 times 10, $50,000. And we're going to then pay their taxes for them until the 10 years runs out, until that money runs out. So we could escrow for taxes, but it diminishes the ability to borrow the money for some other purpose. So if that makes sense, and again, I don't want to get too into the weeds, but we could do that. I have had scenarios in my PowerPoint presentation that they did. It has scenarios, but I had a scenario of a client, actually a real estate agent. One of my old realtors called me. She had a mother-in-law who was turning into a real recluse, and was spending money like crazy, and was down at the casino, and they were very concerned that she wasn't going to be able to pay her taxes. So we set up that loan to pay, hold back money and pay her taxes for her. So at least they knew that we eliminated her mortgage and then put the rest of the money in that lifetime set aside. So it can be done. Most clients don't want to do it because it inhibits their ability to borrow that money for other purposes. What are the purposes that we see people refinancing to take the money out? Certainly in the pandemic, we've had a lot of seniors that have lost their jobs or lost their part-time jobs or have quit them. When you think of all the school bus drivers that aren't working anymore, or they get called back and their children say, "Dad, no more. Now's the time to go." But they like that extra money, so they're taking a reverse mortgage. A lot of clients will use a reverse mortgage as part of a retirement tool to tap into if they need it based upon market conditions of their portfolio. So let's talk about that for just 1 second. And again, I don't want to get too deep into a presentation that might be of more interest to a financial planner, but let's suppose that you retired and you worked at Stanley Works in New Britain. And I use Stanley Works because I grew up in New Britain and everyone is familiar with the Stanley hammers. At the beginning of last year, Stanley Works stock was trading at about $180 a share. Last year, it went down to $70 a share. So if your plan was to draw a certain amount of money from your portfolio and you went from 180 to 70 and you sold at 70, your portfolio would have to double before you could even consider breaking even. So if someone had used the line of credit and drawn the line of credit, now Stanley Works is back up to about 160, 170. They're not back to 180, but they're back to 170. They could then pay themselves back. So it can be used as a leveraging tool when your portfolio ebbs and flows. Bob, you have more questions?
There was one that had came up about a credit line, getting back to when the person passed. Just to clarify, what is left in the credit line cannot be used to pay off anything, because then the balance is at the time of passing.
Okay, so this is an interesting question. Once the borrower passes, that line of credit is frozen. So once and if you're dealing with a family that wants to have you list that property and there's a reverse mortgage and they know mom's got money in her line of credit, it's been frozen, so they can't access that. And that's why I always tell people to make sure they've drawn enough money out of their mortgage, if they do pass, that their family could manage the property while you go to sell it, keep the taxes and plow the snow, so it doesn't become a burden and adult children aren't kicking in to pay for the snow plowing. Because I can tell you that can cut a family in pieces. So you want to be able to have enough money in cash where one of your fiduciaries could access it, but the mortgage gets cut off. Now, one's going to ask me, how would the lender know? Lenders subscribe to a service that monitors when you notify Social Security, which the funeral director will do. The lender finds out that mom has passed. So you will get a sympathy letter before you tell the lender that mom has passed.
Excellent. Excellent. And then there was just one last one, which in a very general sense was just concerning that line of credit, a general question. It can be used for home health care, correct? Without getting into a discussion necessarily of that, but when they're just in a general sense, when there is a credit line, those funds can be used for home health care. Is that correct or no?
That's correct. They can do whatever they want with the money. because it's their money. It's, you know what I mean? And so there's no restrictions on what they do with the money. But I would say anecdotally right now, half of our clients in our pipeline are adult children using a reverse mortgage to keep mom out of the convalescent home and financing it through in-house healthcare. And fully a third right now are doing that. So you'll see that. I will also tell you that the mortgage, the reverse mortgage business changes, and we try to adapt, and the federal government makes all these rules, and they try to be sensitive to that. I want to just spend just a second talking about non-borrowing spouses, because I think it's important. You'll find and then I want to just describe some of the people that might be helped with a reverse mortgage. First is, we do qualify people to make sure they earn enough to pay their taxes and their insurance. So we use what's called the residual income method to qualify. All right. So, and the residual income takes their income, subtracts their expenses to make sure that they have enough money left over. And part of their expenses is taxes. And we really care about that because, we want to make sure that they pay their taxes, because, as I said, that can get ahead of us. Okay. So who might want to buy a home that could use a reverse mortgage? First, because the income is so generous in qualifying people, because we're not taxing them, so to speak, on a principal and interest payment. We're only making sure that they could pay their property taxes. Most people will qualify. So these might be people who have been self-employed all their life. Self-employed realtors, mortgage officers, attorneys, plumbers, all the blue-collar self-employed people. Many of them had good businesses and then retired with no 401k. If you're working at Travelers, they're taking your money, you end up, with some money in your 401k. But if you're a self-employed welder and you put 5 kids through college, you might have a nice house, but you don't have any other savings. So this allows them to sell that house and right size to get closer to their children, to buy something that's all on one level, something that they can age in place, and it's going to be easier for them to qualify. Another group are people who are recent divorcees. We're now having silver divorces, I've named them. People getting divorced later in life. And so they're selling the marital home. So you're dealing with a client who's getting a divorce, and she gets half of the money from the sale of the home, but makes so very little, she can barely qualify for anything. She's only collecting Social Security. A reverse mortgage might be the way that she could double her ability to borrow, or to buy, I'm sorry. She could double her ability to buy by using that money as down payment and leveraging the rest with a reverse mortgage. So silver divorces, so often you may have said to them, you only can qualify for this $100,000 condo and using your $100,000 that you got from the sale of your home. Now you can turn them on to maybe something that they really want. So that's the recently divorced, the self-employed, the people with lower income can qualify this, but they need a substantial down payment. This is not a 5% down loan. We're lending at a little around 50%, and we might go up, depending upon their age, to as much as 75%, but then they have to be in their 90s. Okay. So it is a significant down payment. But let me give you a scenario of someone that you'd go, holy moly. And this was a client that we recently helped with a purchase. And the man was an attorney, and a brilliant attorney. This is a fellow who argued before the Supreme Court, but he had a stroke, and his wife was working, and they had a big, beautiful mansion that was not that old, but it was really very difficult for them. His only income now was his Social Security and what she was earning. And they had a substantial mortgage on this property, but it was a very, very impressive home. So they called me to do just a regular refinance of their existing mortgage because they realized they were struggling to make the payment. So we got talking, and somehow we tripped onto that you could do a reverse for purchase. So the wife said, explain that more to me. So we went over that because their mortgage was substantial in their home, and it would have required that they brought money to the closing, which would have almost wiped out what savings they did have left. When she realized that she could use a reverse for purchase, and we talked about how much they were going to net, how much we would lend them based upon that as their down payment, she went out and found the perfect property for them, a condominium where they could really manage it instead of this monstrosity of a home that they lived in. Now, let me just tell you this. The condo that they purchased was a $600,000 condo. So this was not somebody that was buying an inexpensive home by any means. But what it allowed them to do was transport their equity, eliminate that monthly mortgage payment, buy exactly what they wanted, and hang on to that savings. You've never seen a couple so happy with a purchase. And who would think? Here are this brilliant attorney living in this mansion, helped by a reverse mortgage. And that's why you just have to be aware, and like the Picasso, be aware of it, and call us and we'll help you if you think you have a scenario. We're coming on to an hour. I just want to see if there's more questions before I continue raving on.
We've covered the majority that were there. There have been some specific situations that came up that I think might be better served in a, let's say outside of this, so we don't get tied down to minutia. But I think we're in good shape.
All right. I always think that everyone has a question about reverse mortgages. So if you do contact Bob, we can do a conference call and work out the details either for you or a family member or a client. I also now want to talk to you about that client, the attorney, because we also have portfolio loans that are not FHA loans. They don't have all the bells and whistles of the FHA, but you could close them with no closing costs. So for some people, they might be more appropriate. And so this fellow used our portfolio loan, which, and the reason I mention it, it's for, loans that exceed the FHA maximum value of $825. So if you have someone that's buying a $2 million home, they might want to be helped by a reverse mortgage to finance some portion of it. Also, non-FHA approved condos. And I think that if I were walking on the beach and I came upon a bottle and I opened up and a genie popped out, one of my wishes would be, let's go back to the old-fashioned spot approvals for condos, because it really is hurt the market and certainly hurt first-time buyers not being able to buy them with the ease of FHA. So if you have a non-FHA approved condo, you can use our portfolio loans. All right. Now, I didn't go through my my presentation that's before you, but I think that we've covered most of the highlights of the reverse mortgages. when I looked at that today, I thought it might be a little more, the scenarios are not as real as my own. My scenarios are real people that I have helped, and we've helped at Norcom. So like recently the attorney and some recent divorcees that, thought they were going to buy $100,000 condo. Bob, you have your hand up.
I did. An interesting question had just come up, and it was, I just want to make sure maybe it wasn't covered as kind of focused on enough, which is an important point, that when they use it, the reverse mortgage for purchase, they're qualifying for a certain amount, correct? And whether they use the full amount, what they don't use would go on a credit line? Is
That
that,
is,
if you could
who asked
cover-
that? Whoever asked that question gets a gold star, because that's very, very good. Let's suppose that you have someone that is buying, I'm going to just do easy numbers again. They're buying a $200,000 house, and we're going to lend them 100 grand, but they don't want to borrow 100,000. So they say, well, I'm bringing to the closing, instead of 100, I'm bringing 150. When they do that, they would automatically have available to them $50,000 in their credit line. They're not paying any interest on it unless they use it. So there's no harm or no foul. If they don't want it, it's there, forget about it. And they don't have to repay any of it if they never borrowed it. See, I think that's a misconception. People think that somehow they have to repay the money that's in their line of credit. If you don't use it, you don't owe it. So that person, Bob, would have that money automatically put into their line of credit. If they don't use it, it's completely transparent. It's continuing to grow regardless of the value of their property. And it's their ace in the hole if they do want it.
Absolutely.
And then
I
if
just think important distinction for them, for our realtors to understand that they're not requesting a specific dollar amount from the bank like a front end mortgage. It's their age is qualifying them for a certain amount, and then the mechanisms of the product work the way they.
We take the value of the property, the interest rate, your age, and this is how much you can borrow. If you don't take it, that's okay. It just goes in the line of credit.
Correct. Perfect. Thank you.
So, and then you can draw on it at some point with monthly checks, and you could determine that you want the monthly checks to last for the rest of your life, so they would compute that. Or you could say, make it $500 a month, or I want to take it out in equal installments for the next 5 years. So you can cut and paste that any way you want, and you can recut and paste it if your life circumstances change. I also want to tell you that one of the things that you hear, the negativity about reverse mortgages is, I'm being foreclosed on. Well, is because they didn't pay their taxes. We talked about that. The other thing that has recently changed that makes the product better is the availability for non-borrowing spouses to stay on title or to remain in the home if the borrower passes. And we see this in the refinance world, but you could also run into it in the forward world where someone says, I want to buy this house and I'm selling my house and I want to take care of my wife, but when she dies, I want this house to go to my kids, not her kids. So the way that we can do that is have the borrower put the mortgage in his name. And if you're going to be on the mortgage, you got to be on the title. So he may not want his wife on the title, but she's considered a non-borrowing spouse. So when he passes, she can stay in the home. If she takes title, she may not want to, or signs a lease with the new owner. So if his kids inherit the house, she could sign a lease with them and defer the repayment of the loan. So if you have people we do have people that are remarrying later in life, and they got his kids and your kids and my kids, and so that's a group of people that we can help that before we really weren't the solution for them. So that's something to consider. non-borrowing spouses. Any more questions, Bob?
No, we are good. Everyone's good. So if you had some topics that you wanted to make sure you covered, it is, wherever you'd like to take us, ship is yours.
Well, if you'll indulge me, I'll give you a couple of sales tips, or at least one sales tip that I love to share with realtors. Since we're snowed in, I'll give you a couple of sales tips. But one of them is in the reverse mortgage business. We go to someone's home. Let's say they're doing a refinance, and we make the perfect presentation. They need this loan desperately. They like me. They have every reason in the world to go forward. And then the husband says to me, well, we're going to take your information. We'll look this over and we'll get back to you. Your chances are 50-50. So let's talk about with the realtors. You go to make a listing presentation, and you do the perfect presentation. You're the perfect mix for them. You know they like you. You know that you hit it off with them and you hit your stride. And you get finished, ready to get them to sign, and they say, well, let us look this over. We'll get back to you. Or they say, we got someone else coming over tomorrow. We'll get back to you. Has anyone had that happen to them? If they have, raise your hand. All right. Thank you, Ann. So here's what happened. Before you got there, the husband said to the wife, I don't care what this person says, we're not signing anything today. Don't commit. So even though you know they want to list with you, they don't. If they meet with someone else tomorrow, they go, yeah, it's the same thing we heard from Ann, so let's just go. And you drive by to find out that they've listed with someone else has signed theirs. Here's what happened now. Before you got there, they made a decision, as married couples do. We're not committing. And it's impossible for them to break that with you in front of them. So here's the sales tip of the day. Leave them for a few minutes. Say, I have a brochure I want to get. It's in my car. I'll show myself out the front door. I'll leave it unlocked and I'll just show myself, stay where you are. Go out to the car for a minute, shuffle through some stuff, bring in a folder, and then move to close again. While you're out of the room, 9 out of 10 clients will say, come on, let's go. The wife will say, John, come on. And this person said the same thing that Ann said yesterday. I want to get this house sold. I want to get going. Let's go. And I'm telling you, 9 out of 10 times, if you start and assume the sale, they will end up listing with you. So give them a few minutes apart. And I'm telling you, it works. Because remember, people take the road of least resistance. You're there, they're really ready to go, but they've made that private agreement. So my advice, give them a minute. In private, come back, and you'll list the property. And when that happens, call them, leave me a voicemail message saying, John, it worked.
It's a great tip. It's a great tip, especially in this, not just in the listing parts as a realtors, but also in this reverse space, because there's a lot to consider. They're learning a lot of new information and they need some time to process it, like John said, without you in front of them. They need to be able to talk to each other about all the information they just learned about what it really is about. So it's a great tip. So.
Well, in the reverse mortgage business, people have a problem with those procrastinators with the closing costs and with adult children. Does anyone have problems listing properties when adult children show up? Raise your hand if you do. I don't see any hands. Ann is shaking, but she, okay. Ann, I've been watching you this entire time. You've been my barometer of whether or not people are interested in what I'm saying. So thank you. Well, here's what to do with adult children. I'll give you another sales tip. And I've been at this a long time. So in the reverse mortgage business, but it can be the same with listing properties because we have identical, we run on a parallel plane. So you make a beautiful presentation and then, I don't know, pick the adult daughter says, well, you're only in this for your commission. Does anyone ever had that happen to them? Show of hands. Ann's never had that happen. If they say that to you, here's what you do. Simply repeat exactly what she said and put a question mark after it. And then stop talking. I'm only in this for my commission. And then stop talking. That's the hard part. Repeat the objection, put a question mark, act like you've never heard it before. And trust me, now the onus is on her to explain that, and you don't have to explain, your commission. I will also tell you this about commission salesmen and salespeople, saleswomen, however we want to talk about that. When you go to list a property, that's the first thing they want to talk to you about. How much you're going to charge them. If you talk about the costs before you talk about the benefits, you will not do the deal, or you'll cut your commission. And if you talk about the benefits before you find out what their need is, you will not do the deal. So when they want to lead with that and they're low information buyers or listers in your case, and you put that on the scale against what they know that you're going to do for them at the time, it's impossible for them to justify moving on and signing up for 6%. They just feel duty compelled to try to squeeze you. So when they say that, don't avoid the question, make a note. We're gonna talk about my commission in a minute. Let's talk about, what causes you to want to sell your home. And then let me tell you how I'm going to market and what I'm going to do and show them what your services are going to be before you discuss your commission, because it's impossible for them as low information borrowers or sellers or listers to buy. They'll want to lead with it. Don't seem evasive and get back to it. Mark it down. What are your other concerns? Or how are you going to have an open house during the pandemic? All right, we're going to write that down. Get all their concerns out, address them all, and then get back to the commission.
It's a great, and just to reinforce that, one of the first sales tips I learned many decades ago were fees should only be an issue in the absence of value. So if we're discussing fees and I haven't done a good enough job explaining the value to listing your property with me or whatever it is we're talking about, but it really is a way to, like you said, get them focused on what it is they're getting. So when you tell them what the fee is, they can't believe what a bargain it is. So,
all right, Bob, why don't you tell them how they can reach you if they have questions? And
very good. So I believe everybody saw in the chat, if you're not checking on it, it does have my information on it. I will be sending out some additional information, but for those of you that do have a pen and paper down, it's my cell phone is the easiest way, and I am available to discuss these scenarios with you. And I do take my advisory position very seriously in the mortgage space. And for the older clients, I do hope more people look out to find more information about this. But my number is 203-610-9439. And if you didn't get it, that's okay, because I am going to be following up with everyone to make sure that they have a proper resource that we can be for them in this space to get them the information they need. So.
And I will also send you a better PowerPoint than's there. Bernadette wants to put it on your website, and it is one that had been approved for CE credits. And it follows along with what I talked about. You won't obviously get the CE credits, but there's a lot of good information there, and you can post it on your website.
Okay, good. Just let me check real quick, make sure we didn't get any last minute ones, but unless anybody has some other questions, or we've taken a good 75 minutes of your time, I certainly appreciate it, and certainly appreciate the information John shared with us. And I hope you all could see joining us today how valuable a resource John is for us in this resource space, and a very valuable resource for us to help explain it to people so they understand truly the benefits they get, discussing the costs when it's appropriate and things that go into it, about how the program works for itself. But really, please, I cannot say it enough. Please allow us to be a resource for you in this important space that's going to serve a lot of customers that qualify in the Connecticut market, that can benefit in this program.
You know, I forgot to tell you, my Picasso, I'll end with this. This is a signed original Picasso, signed and stamped, water seal. And I had a client that asked me when he died to sell it and get a lot of money for it and give that money to his charity of choice. So I brought it over to the Winters auction house for them to evaluate it. And they were running out the door and said, "Oh, if you can come back tomorrow, I hate to see a Picasso go out the door, but I gotta go see a client." I brought it home. I locked it in my car, locked the garage, sweated blood that my house was going to burn down. Brought it back there the next day. She said, "This is a signed Picasso. It's an original signed Picasso. The only problem, it's signed by the wrong Picasso." His granddaughter was ripping off seniors on cruise ships and selling these. Yes.
Oh my God.
And you can barely see it, but it's there. Selling them for like $3,000. She says, "Throw it in the dumpster." She said, "I can't sell this because someone might track it that it came from here and that we sold it as a legitimate Picasso." So as I say, you don't have to be an art expert to recognize it as a Picasso, but it's the wrong Picasso.
Great lesson. It's a great lesson. So, all right, Bernadette, I think we're in good shape. I think we give some people some time back, but I really appreciate everybody joining us today.
Yeah, there was some great information. Thank you so much, John, and thank you, Bob, and thank you everyone for joining us. And check your emails and look on our calendar for more presentations on important topics that you guys can use for your business. Thanks again, everybody, and have a great day.
Absolutely. Thank you, everybody.
Thank
Great
you
seeing
all.